Roku's stock recently took a sharp dive, leaving investors scrambling for answers and sparking widespread concern across the tech and investment communities. The sudden drop caught many off guard, especially given Roku's previous reputation as a leader in the streaming device market. Investors and analysts alike began searching for the root cause behind this dramatic shift, eager to understand what had changed so quickly. The catalyst? Walmart's announcement that it would acquire Vizio, a major smart TV maker and advertising platform. This news sent shockwaves through the industry, as Vizio's technology and advertising reach are significant. Walmart's move wasn't just about selling more TVs, it was a strategic play to enter the connected TV and digital advertising space in a much bigger way. This move signaled Walmart's intent to become a direct competitor in the connected TV space, threatening Roku's market share. With Walmart's vast resources and retail footprint, the company could quickly scale Vizio's platform, making it a formidable rival. The competitive landscape for streaming devices and smart TV operating systems suddenly looked much more crowded. Investors feared Walmart's vast retail reach could give Vizio an edge, potentially drawing users and ad dollars away from Roku. The possibility of Walmart prioritizing Vizio products in its stores or bundling exclusive services raised concerns about Roku's ability to maintain its dominant position. The advertising side of the business, which has been a key growth driver for Roku, also appeared vulnerable to new competition. The sell-off reflected uncertainty about Roku's ability to withstand this new pressure, especially regarding its presence in Walmart stores and future ad partnerships. Some investors worried that Walmart might limit Roku's shelf space or even phase out its products in favor of Vizio, which could have a direct impact on sales and brand visibility. The broader question became whether Roku could adapt quickly enough to defend its market share. But as the dust settles, analysts are questioning whether the market's reaction was justified or simply an emotional overreaction. Some point out that Roku still has a strong user base and established partnerships, and that the streaming market is large enough for multiple players to thrive. Others argue that competition is healthy and could even push Roku to innovate further. For investors, the challenge now is to separate short-term noise from long-term opportunity. While the headlines may be alarming, the real test will be how Roku responds to this new threat and whether it can continue to grow in an evolving industry. The coming months will be crucial in determining whether this stumble is a temporary setback or a sign of deeper challenges ahead. Walmart's acquisition of Vizio isn't just another business deal. It's a bold, strategic leap that could reshape the entire streaming landscape. For years, Walmart has dominated retail, but now it's setting its sights on the living room, aiming to become a major force in how Americans watch TV and consume content. By bringing Vizio under its umbrella, Walmart instantly becomes a vertically integrated powerhouse, controlling not just the TV hardware, but also Vizio's SmartCast streaming platform. This means Walmart can influence what content gets promoted, how ads are delivered, and even how customers interact with their TVs. This move raises real concerns for competitors like Roku. With Walmart now owning a major TV brand, it could easily prioritize Vizio TVs in its stores, giving them the best shelf space and marketing support. That could make it much harder for Roku and other brands to attract new users, or even maintain their current presence in Walmart's massive retail footprint. But the implications go even deeper. Walmart can now combine Vizio's detailed viewership data with its own vast trove of shopper information, creating one of the most powerful targeted advertising platforms in the industry. This data synergy could allow Walmart to deliver highly personalized ads, reaching consumers in ways that were never possible before. As a result, advertising dollars could shift away from competitors like Roku, intensifying the battle not just for hardware sales, but for dominance in the lucrative digital advertising market. Walmart's entry could force everyone to rethink their strategies. The market's reaction was immediate and dramatic, with investors quickly pricing in fears of lost sales and a much tougher path to growth for Roku. Stock prices reflected the anxiety rippling through the industry. Still, the question remains: is this new landscape truly as dire for Roku as it appears? Or could there be unexpected opportunities ahead in this rapidly evolving streaming war? As panic gripped the market, analysts at Stifel and Citi offered a different perspective. Both firms argued the sell-off was an overreaction, seeing it as a rare buying opportunity for Roku. Stifel pointed out that Roku's dominant position and strong fundamentals were being ignored amid the headlines. Citi echoed this, maintaining a buy rating and a $100 price target, signaling confidence in Roku's long-term prospects. Their reports emphasize that the Walmart-Vizio deal, while notable, doesn't dismantle Roku's core strengths. Instead of a company in crisis, they saw a resilient leader facing a manageable challenge. The message: the market's fear has created value for patient investors. Stifel's analysis centers on the idea that the market's reaction was emotional, not rational. When news broke about Walmart's entry into the streaming device market, investors panicked, leading to a sharp sell-off in Roku shares. But Stifel suggests this response was more about fear and uncertainty than a true reflection of Roku's underlying business fundamentals. Roku remains the leading TV streaming platform in North America, measured by hours streamed, a sign of deep user engagement. Across the US, Canada, and Mexico, millions of households rely on Roku for their daily entertainment, making it a staple in living rooms and a familiar part of family routines. Its open, agnostic platform has earned trust from both consumers and content partners, making it the Switzerland of streaming. This neutrality allows Roku to offer a wide variety of content, appealing to users who want flexibility and choice, while also attracting major streaming services eager to reach a broad audience. Stifel argues that Walmart's move doesn't erase Roku's brand equity or user loyalty overnight. The relationship Roku has built with its users is based on years of consistent performance, ease of use, and a reputation for reliability, qualities that can't be replaced instantly by a new competitor, no matter how large. Millions of households are deeply integrated into the Roku ecosystem, unlikely to switch just because of a new competitor. For many, Roku is more than just a device. It's the hub of their home entertainment, with personalized recommendations and seamless access to their favorite shows and movies. The firm believes the sell-off has created a disconnect between Roku's true value and its stock price. While the market may be reacting to short-term headlines, the fundamentals, such as user growth, engagement, and platform strength, remain solid. For investors willing to look past the headlines, this could be a prime entry point. Those who focus on the long-term story may find an opportunity where others see only risk, especially as Roku continues to innovate and expand its reach. The core pillars of Roku's success remain intact, positioning the company well for future growth despite the noise of the moment. Citi's take is equally bullish, calling the market's reaction overblown and maintaining a $100 price target. Their analysis suggests the Walmart-Vizio deal will have only a very modest impact on Roku's business. Roku's user acquisition channels are diverse, spanning partnerships with TV makers and major retailers beyond Walmart. Even if Walmart shifts focus to Vizio, Roku's reach remains broad and resilient. Citi's models show Roku's growth and monetization engines are still strong. The firm's message: the fundamentals haven't changed, and the dip is a temporary dislocation. For Citi, Roku's leadership in a massive, growing market is undiminished. The opportunity for long-term investors is clear. Roku's real strength lies in its platform, not just its hardware. The Roku OS is the central hub for millions of households, generating recurring revenue through ads and content distribution. Roku leads the US, Canada, and Mexico in hours streamed, a testament to its sticky, user-friendly experience. This dominance creates a network effect. More users attract more content and advertisers, making the platform even stronger. Even with Walmart's backing, Vizio lacks Roku's content breadth, brand recognition, and user loyalty. Consumers trust Roku's neutral, open approach to streaming. This established leadership forms a defensive moat against new entrants. Analysts believe this moat will help Roku thrive even as competition heats up. The numbers behind Roku's business are compelling. Tens of millions of active accounts and consistent user growth make Roku a key gateway for streaming audiences. Roku's dual strategy, selling its own devices and partnering with TV manufacturers, ensures broad market reach. But engagement is where Roku truly shines, with billions of hours streamed each quarter. High engagement means more ad opportunities and stronger revenue growth. This creates a powerful flywheel. More users, more engagement, more revenue, and more reinvestment in the platform. Analysts see this data-backed cycle as the foundation of Roku's long-term value. It's why confidence in Roku remains high, despite short-term market jitters. A closer look shows why the Walmart Vizio deal may not hurt Roku as much as feared. Roku's distribution isn't dependent on Walmart. It sells through Best Buy, Target, Amazon, and more. Its partnerships with TV makers like TCL and Hisense ensure Roku OS remains widely available. Millions of loyal Roku households are unlikely to switch platforms for a new TV brand. Consumer habits are sticky, especially with tech used daily. Roku's open platform remains a key differentiator, while Vizio under Walmart may become more closed. This Switzerland of streaming positioning keeps Roku attractive to both users and content partners. The long-term impact from the Vizio deal is likely limited. Investors now face a choice: follow the crowd's fear or see the opportunity highlighted by analysts. Roku's leadership in streaming, massive user base, and high engagement create a strong foundation. The Walmart Vizio deal may shift the landscape, but it doesn't erase Roku's advantages. Citi and Stifel argue the market has overreacted, punishing Roku's stock more than the facts warrant. For those who look past the noise, the current price could be a rare entry point into a long-term winner. The consensus: Roku's fundamentals are strong, and the fear is overblown. Opportunity often comes disguised as crisis. For patient investors, Roku's story is far from over.